Andrew Freris is now with us, as well as Mitul Kotecha is with us. Let me start with you, Andrew, first. What do you make of what's happening in the global markets in terms of, how various asset classes are responding? We are seeing some asset classes are responding in extreme manner or readjusting to something which probably came in as a shock.
Well, it should have come as a shock because we are now quite used to major banking crisis starting with 2008. I'm not being cool, calm, and collected. And now you had a classical case of a bank that was trying to get as high yield as possible, both in terms of profits and what it gives to its depositors. And then it found out that by piling into government bonds, it was an extremely unbalanced position that came crashing down once the Fed started to increase interest rates. Terribly simple. I'm not being clever here. I mean, it is unbelievably simple. So the market classes, very strangely enough, in fact, the US dollar weakened. Okay, it has weakened both against the sterling, against the euro, against the Aussie dollar. And let's say, strictly speaking, it would have strengthened because apparently there has been quite a big move into buying US government bonds. Hence, their yields collapsed from 5 down to 3% as their prices went up. I mean, it is an incoherent mess. If you tell me how the assets are reacting, they are reacting in a panic. In other words, people are piling into US government bonds in the reality or in the realization. That was exactly what happened with SVB, because they were also very heavy into bonds, only to find out that they made big losses. It's very, very easy to be an armchair theorist, but on the other hand, occasionally, I think that a hell of a lot of the market participants, particularly traders, would have done very well to attend a 101 economics class.
Right. Mitul, what do you make of the current market situation? How different asset classes are reacting, especially emerging markets, Bitcoin, gold? How are they just reacting to this news flow? Mitul, this one is for you.
Oh, sorry. Okay. Well, look, I mean, clearly the market is very volatile and we're seeing complete big shifts in, we look at VIX, we look at the move indices, rates and FX vol has increased and equity vol has increased significantly. There's a lot of nervousness out there, right? The Fed has put a significant backstop in place for US regional banks and US banks in general. That, I think, is very, very supportive. It should at least stop the rot in terms of deposits flying out of the US banking sector. The fact that they're insuring now or able to make good not just the uninsured deposits, but also the insured deposits is very significant. So in a sense, what's happened here is pretty significant. It has implications for policy going forward. As Andrew just mentioned, obviously, we've seen a significant rally in US bonds. Markets have pared back, tightening expectations to the point where now there's only a 1 in 2 chance of priced in for a Fed hike at the next FOMC meeting. And again, it seems like an overdone reaction, but now there's a real chance that the Fed will pause. So I think amidst all this volatility, the Fed is also trying to gauge the market reaction. We've had substantial weakness in European equities. Today, we've had, or will be seeing that in the futures. We've had we've had some weakness in US markets, but not significant. Bank stocks certainly came under a lot of pressure. So I think there's still a lot of nervousness here. And, we wait to see whether the Fed and the FDIC and the US Treasury has done enough to put a stop under the rot at present.
Right. Andrew, what do you make of the correction that we've seen in select banking names? You think markets are really now repricing the sort of risk banks are taking in?
Well, they have to. And what I find absolutely fascinating is also the overall behavior of the cryptocurrencies that are supposed to be, of course, completely divorced from all that. And they're unbelievably and inherently contained into all this. Incidentally, I'm right now writing a piece on the involvement of crypto into SVB. I mean, it is enormous. I'm not blaming that. I'm not blaming the cryptos into that. But the idea is somehow that you invest in cryptos, it's a safe asset. It should have flown out of the window. But as you're saying, it is still interesting that the US dollar continues to stay weak, despite the fact that the liquid part and the big part of that is going back into US government bonds. As I said, it is like a rat trapped you're moving frantically from one edge of the cage to the other, okay, terrified of what's going to happen next. At this level and at this stage, one despairs by the inability of people to learn. If you buy risky assets, you face risk, full stop, and then you have the colossal moral hazard of the Fed coming in to save unsecured deposits. I know they're doing this not because they feel sorry for the depositors. They're feeling that if they don't do that, this is going to spread to all the rest of the banking system. So they have a helpless task. But the fact that American taxpayers' money will be ultimately used to bail out the depositors of the bank, I don't wish them ill, but it is really unacceptable.
All right, got that point. Mitul, as you said that, the Fed might actually slow down, or markets are pricing in that they may actually slow down in terms of hikes. What is the sense that you get? What will that actually do to liquidity?
Well, look, I think liquidity is at the moment tightening, but again, there is these backstops in place, right? And I think what we're probably going to see is this nervousness still result in some rush for safe havens, and that could put the Fed to a point where they even pause on QT, because it's hard to have quantitative tightening at the same time as you've got this liquidity backstop in place for banks in terms of these measures that are going to basically provide this financing that the banks couldn't get otherwise. What I think is ironic that for example, Silicon Valley Bank, it had not invested in risky assets. It was long-term bonds and MBS, and unfortunately, as a lot of banks have done, they weren't able to get their hands on this for a long period of time, and hence the ability now to provide, or for the Fed FDIC to give capital based on these collateral that's given at par, I think is very significant. So, look, we will see liquidity pressures, there's no doubt, but I do think that a lot has been put into place. The Fed repricing has been significant. We've taken off around 100 basis points from the terminal rate, from around 5.75 now to about 4.75% as a terminal. That's weighed on the dollar. The dollar index has come under a huge amount of pressure. But look, I do think we probably may be already there in terms of the price. A lot has already been priced in, unless we see a significant contagion and a massive rush of deposit withdrawals through the banking system. It seems unlikely that we get this pressure intensifying much further. And also, you mentioned earlier emerging markets. We have not seen a huge amount of contagion to EMs at this point in time. Some crowded trades have been taken off. But we're not, the dollar weakness is helping EMs to some extent. So, again, we wait to see how much this reverberates around markets. But so far, it still seems relatively contained. I'm not saying it's over. I think we're going to see nervousness continue and liquidity pressures intensify. But, I think, as I said, the authorities in the US have done a lot to provide that support that could stop this from worsening more significantly.
Right. Andrew, where are you investing now then? Which asset class do you believe is the safest at this point of time?
Defense. Very simple. Okay. Defense budgets right across the world, including Asia, which has been completely unobserved. It has gone very, very quiet about that. Okay. Have increased enormously, and they will stay up even after the Ukrainian war finishes, because this highlighted enormously the importance of being well prepared where frictions exist. And Asia is packed with frictions. India with Pakistan, India with China, Japan and South Korea with North Korea. Of course, China feels completely encirclled now, not only by their right-door neighbors, but also by the United States. And if you go to Europe, of course, you have on the, in inverted commas, European card, Ukraine with Russia. Russia still has open sore wounds with Georgia and Moldavia. Greece and Turkey have been at each other's throat for a very, very long time. All these, I'm sorry, it seems very cynical, is sweet music to the ears of defense companies. Defense companies. I know there is an enormous issue concerning morality and concerning, if you want, the political correctness, but I'm sorry. I'm advising my clients selectively. Not all defense companies are good companies. But as a sector, it has a huge glowing future in front of it. Horrible things to say. And also think about that. In the case of defense companies, their main clients, which is governments, are interest rate inelastic. In other words, increases in interest rates don't bother them. Very, very few companies will say that my clients are not affected by increases in interest rates. The company themselves might be affected, depending on their gearing, but defense is, I think, the only companies that I can think of that their clients are uniquely interest rates insensitive. Love it.
All right, Andrew, thank you so much for taking our time for us. Mitul, always great to get perspective. As we are speaking, we're back to the day's lowest point. Let's just pull up the chart of the Nifty. You'll get a sense of what I'm saying. We went towards closer to 17,160, 70 levels, but now we are back to 17,080. So you can see that mountain over there that I'm talking about. It just went up and then again, you saw selling pressure coming in.